So once again, good evening, everyone. Thank you so much for joining the session today. My name is Yogesh, and today is going to be the last session for the Investor Education Week. And today we are going to discuss about trading strategies. We are going to answer all other questions if you have regarding the platform. And since today is the last session, so we can stretch it as per your convenience. But as much time as you have, please devote it. And if you have any questions, do write on your chat window, and we'll definitely try to take all the questions what we have today. Apart from this, by the end of this week, we'll be publishing the recording. We'll be uploading the recording of this entire session of Investor Education Week for your understanding. So in case if you have missed a day due to any issues, due to any problems, or you have not been able to devote time, or you want to have just a quick recap, you can look at these recordings. You can check once again. And if you have any doubts, we can have a one-on-one session after this week. And I'll be more than happy to help you out and take you through this journey once again. So drill is the same, everyone. Now I see a lot of familiar names. In last 4 or 5 days, we all have been together, and we have been trying to understand financial markets as we know it. So first and foremost, if you can hear me properly, once again for the last time, if you can hear me properly, if you can see my presentation, please give me a yes or a okay. So it will be easy for me to proceed further. Just want to make sure that everybody can see, everybody can hear me properly. I'm audible enough. Okay, perfect. Great. So I see a lot of people have joined today as well. Today is the last session. But those who are joining today, don't worry. We can have a recap of this tomorrow whenever you are free. Just book your one-on-one sessions, and I'll be again taking you through this journey that what we discussed on day 1, day 2, and try to divide it. So once again, guys, we are going to discuss a lot of strategies today. And please understand these strategies, what we are going to talk about. Some of them are still running right now. Some of them we have prepared in the past. It has worked. And then the very nature of the strategy is that it is available for a specific time period. Once the time period goes and once the position is closed, profit or losses are booked, then again we have to wait for that strategy to come back. So today we are going to through a lot of strategies. I will be using some of my past strategies also, which are not in function right now due to market movements. But again, I just want to tell you that there are more than one ways to trade in the market, because for many of you, online trading just means is speculation. Today, by the way of showing you strategies, I'm going to open a completely new window in your investment idea. So you will know that now it's not about allocating your portfolio to just day trading or speculation. It's more than that. You can allocate your portfolio into day trading, speculation. You can do it long-term portfolio, and you can do strategies also. So now there are 3 parts of your portfolio: day trading, long-term, and strategies. And what are these strategies? We will be talking shortly today. So great to see more and more people joining today. Okay, I have already a few questions. Okay, how to invest in soybean oil September 2021 on trend line and support. Okay, so we'll go through these technicals. First, let's switch on to our platform first, since we have been in the habit. So again, those who have your platforms, please switch on to your platforms. Those who are new, do not worry, reach me out on my email, and I'll be able to provide you platform after the session is over, and I'll give you a one-on-one individual training as well. So let's share the platform and go through our daily drill. Okay, I think yesterday, if you attended the session, we talked about technicals, right? So if you still see the lines which we drew right here, let me make this time period smaller. Is it there yet? 30 minutes. So as you can see that this 1794 resistance has not been broken yet. And this is the line which we drew. If we see last 15 minutes, so that resistance still strong, and the support of 1781 hasn't been properly broken yet. So it's still a good buy at 81. So let's see the watch list today, guys. Open your watch list, what we prepared on day 2. Okay, let's talk about this. What is the lowest price of the gold which you can see right now? What is the lowest gold has hit today? Now I'm sure everybody knows how to see the watch list. We have been seeing gold and Bitcoin from last 4 days. So tell me, what's the lowest gold has hit today? Actually, write together. So I'm asking you the lowest as well. Write the lowest price of gold and write the highest price also. Okay, perfect. Great. Okay, perfect. Okay, so everybody is getting this. Great. Well done, guys. So now I see all these answers coming in. So you have clearly mentioned it. L 1774, which is lowest, and highest is again 1792. So now you know that lowest gold has hit is 1774, highest it has hit is 1792, and the current market price, as we can see, is again 1785, 1786. So if you remember, yesterday when it went down to 1777, 1778, then it went back to 1781. We took a trade that particular time, which was around 56 ounces when we bought around 1782. So currently you see a small profit here. Again, when it goes to 1790, this will be bigger, but if it goes down below 1782, I will be in a loss. Now, once we are trying to understand this entire platform and everything, now we'll talk about what kind of strategies are available and how to take trades on the basis of this strategy. Perfect. Okay. Now, first and foremost, your strategy should always revolve around one thing. Yesterday, I talked a lot of times, and the day the session has started, I told you what we are not going to learn in this. We are not going to learn any secret techniques of making money. We are not going to learn any talks about insider information. We are not going to learn anything like 100% correct magical technical indicators. I'm not going to give you a pen drive with some magic technicals in it which can 100% make money for you. I'm not going to do all this because all these things never exist. If somebody tells you otherwise, don't believe in it. If it was this easy to predict markets, everybody else would be doing it, right? So there is no secret to make money. Just one. There is one secret though, and that secret is focus on minimizing your loss. If you focus on minimizing your loss, your profit will automatically continue to go higher. And that's why we are here to do for. Now, when I say market neutral investing, what does the word neutral means? Neutral itself means something which neutralizes the impact of something, either neutralizes or at least reduces the impact. So we are talking about equity market neutral, we are talking about market neutral strategies, we are talking about strategies which overall reduce the impact of the market fluctuation. One thing which exists more than anything in the portfolio is what? It is volatility, fluctuation, right? Whether it is Brexit referendum, US elections, whether it is pandemic, whether it is Fed meeting, whether it is earning, one thing which is constant is change, is volatility, fluctuations, right? So market neutral strategies are all about reducing the impact of the volatility in your markets. And how do you actually do it? So I've prepared a small chart over here explaining when you use strategies where the market neutral fits the best. Now, one thing is passive equities. So if you see the first block which is mentioned on this chart, on this graph, the horizontal axis shows the market risk and the vertical shows security specific risk. Now, if you have a portfolio, right? If you have a portfolio of a bunch of stocks and you just bought those stocks and you're not doing anything, in your mind, that portfolio doesn't have much risk because you're not doing anything. You have just bought and hold on for it for a longer period of time. But if you see, passive equities have risk. Look at on the horizontal market risk area where it is, plus the reward which it see. Let me just second. Okay, great. Risk and yeah. So now what you see on the extreme right corner, the market risk it takes and what is the reward of that premium. So when you make passive equities, you see that there is a certain reward at that particular risk. But there is no the security specific risk. When I say security specific risk, and when we talk about the reward, these are two different things. So when we are looking at passive equities, yes, there is risk and then there is reward. There is active equities. Now, when you see active equities are what? When you have a fund manager who is dealing with your equities, they are buying and selling, right? Again, market risk is higher, but reward is also. When you talk about equity hedge, what does the word hedge means? Hedge, the hedge word itself means to provide a protection. So what normally what the farmers do when they have big fields, they create these separate hedges so that the field doesn't get destroyed. So hedge means a kind of barrier. Okay. And lastly, it comes equity market neutral, which means you try some market neutral strategies which has very low market risk. So if you see on the horizontal scale of the market risk, see that green box. All of you can see this green box. Look, this green box come at the very beginning, which means the market risk in that particular green box is very less as compared to your passive portfolio. Till now, what you were thinking that if I have bought some stocks and I have left those stocks and I'm not doing anything, my risk is less. But there is a way to reduce that kind of risk, and that is by using strategies which are in that green box, because that green box has less market risk, but it has a very specific security risk, right? Now, let's understand. So if you see, there is a alpha. Alpha means when your returns outperform the market return. So when you're doing market neutral strategies, it has lower market risk and a higher alpha. And we have tried this, we have tested this, and that is why we are going to bring such kind of strategies. Now, how market neutral strategies work? The first kind of strategies which we can work with the markets, these are called pair trading, also called as statistical arbitrage. Now, I have from day one made sure that whatever I tell you, it goes in the most easiest terminology, most easiest words. So I don't want to confuse you by using the words market neutral, statistical arbitrage. So let's call it pair trade. Okay. The terminology is statistical arbitrage, but I would still tell you use the word pair trading. Pair trading. So when I say the word pair, you understand there are two instruments involved, right? So that very much is clear to everyone. The moment I say the word pair, that means there are two instruments involved. Trading, which means you buy one, you short sell another, and that is how the strategy will work. But what does it mean? So pair trading involves simultaneously buying and selling or short selling stocks of companies in the same economic sector or peer group as defined by the manager. Now, how does this work? And I'll show you flyers and strategies right away. Tell me, when I say word Pepsi, what is the next word which comes into your mind? Write it on the chat option. When I say Pepsi, what is the most closest beverage you can feel which is closest to Pepsi? Go for it, guys. Last day today. So let's use this chat option as we can. Okay, I'll start getting answers. Great. We're surprised. Everybody thinks in the same manner. So when I say Pepsi, what comes into your mind? Coca-Cola, right? Exactly. And when I say MasterCard, what's the next company comes into your mind? When I say MasterCard, I think there is no other company apart from MasterCard and, of course, Visa. So the point is, when we are talking about MasterCard, it comes in the mind Visa. When we talk about Coke, Pepsi, Coke. Why it comes into your mind? Because these two companies are so close. They're so relatable that, but somebody said American Express also, sure. Most of the time, when you say MasterCard, it's Visa. Now, why it is like that? Because these two companies, they are so close. They have the same target market. They face the same regulation. So their stock price also moves almost in the same direction. Okay. Tell me if you can see this. I'll just switch on my whiteboard and I'll make it less transparent. Okay. Okay. Tell me if, okay, let's say this is Coca-Cola. Can everybody see me drawing on the whiteboard? Can everybody see this drawing? Please send me a yes or okay, because last time there was a problem with the whiteboard, I realized. Can everybody see me drawing on the whiteboard? Or I have to share it? Okay, everybody can see it. Perfect. Thank you. Great. So this is the graph of Pepsi. Okay. Now you'll be surprised, most of the time, Coca-Cola, let me put Coca-Cola as in red. If Pepsi is like this, Coca-Cola will be more or less like this, right? Okay. Now let's say markets went up and Pepsi prices went up as usual, but something happened. Coca-Cola's earnings came bad, maybe CEO stepped down, something happened. Coca-Cola prices fell. Now you see this big gap, right? Everybody see this big gap. But tell me, now this gap has occurred. Why this has occurred? Because due to situation and circumstances, Coca-Cola prices have dropped. Pepsi prices still continue to go up. So there has been a special event. But tell me one thing. Don't you think that this event, as much as it can happen, will still going to honor this trend which has been going on, right? Eventually, after this event is over, we will see this gap, which was not very big, but it went bigger, right? It went bigger because of the market anomalies. It will eventually close. Either Pepsi prices will come down and match with Coca-Cola, or Coca-Cola prices will go up and match with Pepsi. So what I do, I will short sell Pepsi and I will buy Coca-Cola and try to make a pair trade out of it. So tomorrow when this gap closes once again, which we have seen historically happening, if markets go up, my expectation is that since I am short sell on Pepsi, so if markets goes up, Pepsi will also go up, Coca-Cola will also go up. But my expectation will be that Coca-Cola prices should go higher more than Pepsi. So my loss in Pepsi is covered by my profit in Coca-Cola. How's that? Make sense? It does make sense. What we are trying to do, guys, here, we're not trying to make profit in both the positions, right? Why I'm short sell on one and why I'm buy on another? Because all I'm expecting is that if markets go up and this gap starts getting filled, all I am looking is that this particular price should go up way higher than Pepsi, so that my loss in Pepsi is covered by my profit in Coke. Okay, question. Short sell means sell some shares, not all shares. No, short sell doesn't mean that. Short selling means when you borrow the exact amount of shares, you borrow the amount of shares and you sell in the market. Remember short selling, when you are short selling something. Short selling means when you are borrowing stuff okay, from the broker, when you're borrowing shares from the broker and selling live in the market, and when price comes down, you buy it back. Something what we did on day third. Okay, try to remember, practice this in your platform, guys. That's why I tell you, keep practicing every day so you'll remember this. So short selling means, so, and pair trades have to be done in exact quantity. So if you're buying, okay, let me replicate this. Clear and turn the whiteboard off. Let me show you this on the live platform, how it will work. And rest of you can replicate this trade with me. Let me do this. Okay, right now I have a platform on, and I'll make this, I'll search Pepsi. Here, and Coca-Cola, sorry, separately. Do it in your platform if you can. Pepsi, Coca-Cola. Okay. And okay, let me see if I can reduce the size of this chart. Okay, look at both the charts, guys. I'm putting left and right. Both 10 months chart. And look at the similarities. So you know what I mean, right? Look at the similarities. Now, if you have to take this trade, again, guys, today I'm just telling you how to take this trade, but I'm not saying that you have to take this trade in your live account. This is just for your understanding that how a pair trading works. Okay, so please be very careful. I'm explaining you how the pair trading works. This is not something which you have to do in your live accounts, because the trades, these particular trades are taken when the consultant studies the gap between Pepsi and Coke, and then when the gap is big enough to enter, that's when you enter. But right now I'm just telling you how to take this particular trade. Oh, sorry. Oh, okay. Wait. Can you see my chart now? You can see my chart now. Okay. Here. Okay. Now I hope everybody can see this. So look at the Pepsi chart and look at the Coca-Cola chart. It is almost the same. But what is different in Pepsi and Coca-Cola is their price. One share of Coca-Cola is $56.7. Okay. And Pepsi shares are $157. So obviously, if you buy 100 shares of Coca-Cola, it is $5,600. But if you buy 100 shares of Pepsi, then it is $15,000. So it's a big gap. So how you do it when you have to take a trade? Now I'm just expecting here that Pepsi prices have gone up and Coke prices have come down. So let's say if I'm expecting Coke will catch up and go up, or Pepsi will catch up and come down. So what I have to do is short sell Pepsi and buy Coca-Cola. But because it's a pair trade, so I have to do equal value, which means, let's say I try to short sell say $15,000 worth of Pepsi, and at the same time I buy $15,000 worth, sorry, not the number of shares, $15,000 worth of Coca-Cola. You see what I did there? I did equal value because it's a pair trade, right? So I want to make sure that the neutral hedge is created in such a way. Look at my positions here. Where is it? Yeah. See my positions. Not this, not gold. Look at this. $15,000 short sell Pepsi, $15,000 buy Coke. So basically, I'm doing an equal value trade over here, right? Let me close all other stocks here. Let me close Tesla. And let me close. Okay, let me close gold as well. Book my small profit. Okay, I'm just looking at peso. Today, we are all going to do strategies in this. So let's this account be for that. Okay, so now if you see, at one point of time, I will expect that my profit in one of the position is higher than the loss in the other one. Now, this is how all the pair trades would work. But only point is, so there's a question here, how did you get into pair trade in the platform? Very easy. all you have to do is go to the platform and search for the instruments. Okay, you search for, so I search for Coca-Cola, I search for Pepsi, open the order tickets for both of them, and short sell one and buy another, right? So put equal value, equal amount, not number of shares, because the share price is different in both of them. So you have to do equal value, right? So this is normally how you get a pair trade. So this is, again, this is just one pair. Okay, now let me show you a dedicated strategy towards it. A lot of investors, they have done this, a lot of investors, they are doing it, but again, the movement on these strategies depends a lot on the market fluctuations as well. So we'll keep this Pepsi and Coke right here, and let me show you a strategy called NASA, which means in NASA, NA stands for NASDAQ index, which is a tech index in US, and SA stands for South African index. Okay, now let me show you this. Question. So unlike in the Indian market, equities can be bought in fraction US markets. Yes, you can. You can buy stocks here in fraction. Even now, if you're talking about direct equities in Interactive, even they also allow now to buy in fractions, not necessarily in lots. So you can definitely buy here in fractions. So that's why, that is also one of the reasons that pair trading will be easier over here. Okay, now I'm going to show you here. Okay, Chrome tab. Okay, this one. I hope everybody can see this. Everybody can see my screen. I've opened a number of strategies, so I'm going to share all those tabs with you, and I want to make sure that you understand this as well. Everybody can see my screen. Give me a yes. NASDAQ 100 in South Africa 40, also called NASA trading strategy, which has been developed by a lot of researchers over here, and we have been trying to understand this. Now, I will zoom in. There are a lot of numbers, guys. Trust me, I have told you since day one that I'm going to make these things easier for you, and that's what I'm about to do it. Don't read anything else. Only which I tell you to read, just read that, okay? First, see what I'm showing it to you. I'm showing you year 2008, year till date 2021, which means we are looking at a data from 2008 when financial crash happened to 2021, which means it's been almost 13 years, 12 years, 13 years of data. And this is last when it was updated. I think the date it is 18th May. Okay. So it's a long-term strategy. It goes on. Now, all I am asking you is you have to look at, okay, right here, my whiteboard on slightly, but I want to keep it very transparent, and I need to use this. Okay, just look at NASDAQ yearly return. That's all I want you to see right now. When I say NASDAQ yearly return, what does it mean? It means that if you had done nothing, just bought the NASDAQ index in the beginning of 2008. Now tell me when you are looking at this, okay? I want answers here. If you had bought NASDAQ in the beginning of 2008, what would have been your profit or loss by the end of the year? Give me the answer. If you had bought NASDAQ index, did nothing, did not buy anything else, just bought NASDAQ in 2008, what would have been your profit or loss by the end of 2008? Okay, that's great. I love how people who have joined today on the last day, unfortunately, but all of them are so involved and looking into these strategies. So that's great. So just guys, for you, because you have also joined the last day, do not worry about this. I can have one-on-one multiple sessions with you, and I will bring you back to speed on this. Okay. Somebody said profit. So there is no profit. Loss, definitely 42%. There's a 42% loss. Somebody said 169%. I don't think it's one. So 169% is not the right answer. But if you see here, so that's all right. Let me show it to you here. That if you had bought Nasdaq in 2008, then you would have faced a loss of 42%. So now you know what to see. Okay. Why I keep asking you these very easy questions? So if you're looking at some other number, I'll bring you back to what I want you to see right now. So if you bought Nasdaq in 2009, you would have made a profit of 53%. 2008, you would have made profit of 8. 2010, you would have made profit of 18%. 2011, you would have made a profit of 2%, 15%, 32%, 18%, 8%, 8%. So, guys, isn't this amazing that Nasdaq from 2008 till 2021, I mean, 2021 is not complete, but till that, whatever it was, there has been loss in 2008, and then there has been a minus 1.6% loss in 2018, which means if you had invested every year in Nasdaq index, nothing else, did not pay money to your fund manager, did not paid money for research, did nothing, just took your money and put into Nasdaq, every year you would make money like 50%, 18%, 2%, 15%, 32%, 18%, 8%, 8%, 31%, 38%, 48%, and currently 3%. And say till August. It's amazing, right? I mean, then in between 2009 till 2021, Donald Trump happened, elections happened, pandemics happened, Brexit happened. But if you just had invested every year into Nasdaq, you will make all these returns. So what does it tell us? It tells us life is not that complicated. All we need to do is just find the right instruments. Okay, that being said, we should not neglect the fact that Nasdaq is a tech index, right? So tech rises in a certain manner, tech falls also. So we have to be very careful when the tech falls. So we definitely need to diversify. Okay, now you have seen Nasdaq. Okay, now what I want you to see. Now you move on to the next column. Now I'm talking about South African index. Now don't look at Nasdaq. Okay, everybody with me on this. Do not look at Nasdaq. Just look at South Africa. South African yearly returns. Now, if you see South African yearly returns, by the same token, I can see it was negative in 2018, negative in 2016, negative in 2011, negative returns in 2008, right? Although Dow Jones fell down more than, Nasdaq fell down more in 2008 as compared to South Africa. What does it mean? It means that if you had bought Nasdaq index in 2008, you would have lost 42%. But if you had bought a South African index in 2008, how much would have been your loss? Those people who answered it wrong last time, you know who you are. Can you answer me the question now? If you had bought South African index in 2008, what would have been your loss? I'm telling you it's a loss. How much it would have been? Everybody can answer this, but I want specifically answers from those who got it wrong last time. Perfect. Great. Thank you so much for your answer. So it's 26%, right? So if you had bought South African index, what is a South African index? South Africa 40. It's not 4%, it's 26%. You would have lost 26%, right? Now, what is South African 40? South African 40 is an index which is tracking 40 companies of South Africa. Okay. And if you buy South African index, you are automatically investing into those 40 companies. So it goes up or down, depends. So if you had bought Nasdaq, you would lose 42%. If you had bought South Africa, you lose less because South Africa went down by 26%. So that means, in a way, South African index outperformed Nasdaq in 2008. Can I say it? If I say the statement, and please hear me out, if I say the statement that South Africa index outperformed Nasdaq in 2008, is it true or false? Answer. If I say South African index outperformed Nasdaq in 2008, Is it true or false? Okay, 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 okay. Everybody's saying true. I'm looking for one person to say false. Okay, one person said false. False is wrong. False is wrong. Why? Because I'm saying that South African index outperformed Nasdaq. It did outperform. So outperform doesn't mean in only in profit. Outperform means that if Nasdaq went down by this much, so this is South Africa, this is Nasdaq. If Nasdaq went down by this much and South Africa went down by this much, you're still better in South Africa than in Nasdaq. So South Africa did outperform Nasdaq, correct? In 2008. Now, tell me, and now this is where your observation starts. Tell me, look at both the performances, okay, and write it in the chat option. When, apart from 2008, how many times South Africa has outperformed Nasdaq between 2009 till 2021? Look at this chart. You know what outperformance means, right? So in both profits and losses, tell me how many times South Africa has outperformed Nasdaq after 2008. So 2008 doesn't count. After 2008, how many times South Africa has outperformed Nasdaq? Go for it, guys. Go for it. I hope you're just looking at these two columns, right? So this is year, this is Nasdaq, this is South Africa. I just want you to look at all this and tell me after 2008 how many times South Africa has outperformed Nasdaq. Okay. 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 So I think the popular opinion here, okay, it starts from, okay, let me see. Everybody has said 2012. So 2012, Nasdaq yearly return was 15%. South Africa was 22. Exactly right. Absolutely right. Those who said 2012, that is absolutely right. 2021. Okay, considering the numbers so far, yes, but 2021 still a long way to go. So we'll see by the end of the year. But yeah, I mean, when you say numbers, definitely it's not accounted. But yeah, in 2012, South Africa outperformed. Somebody has said three times in 2011 also. In 2011, no. In 2011, South Africa was negative 1%. Nasdaq was positive 2%. So it did not outperform. Okay, okay, okay. Two times, twice in profits, thrice in losses. Okay, now let's see this. Let's see it from 2008 onwards. 2008, Nasdaq negative return, South Africa negative return, but South Africa outperformed. So this was one. And then 2012, South Africa positive return, Nasdaq positive return, but South Africa outperformed, right? Since then, if I see another years, 2019, Nasdaq outperformed, 2010, Nasdaq outperformed, 2011, Nasdaq outperformed, 2013, Nasdaq outperformed, 2014, Nasdaq, 2015, Nasdaq, 2016, Nasdaq, 2017, Nasdaq, 2018, Nasdaq, 2019, Nasdaq, 2020, Nasdaq. Now let me ask you one subjective question. If I wanted to ask you that you have these two indices and I want you to buy one and short sell another, write B and the name of the index and S and the name of the index, what you want to buy and which one you want to short sell. Looking on the data which you see right now, if I would ask you that you buy one index and short sell another at the same time, which index would you buy and which index would you short sell? On the basis of the data which I'm showing it to you right now. Write B for buy and the name of the index, S for short sell and the name of the index. what would you sell and what would you buy on the basis of these numbers? Okay, go for it, guys. Go for it. Okay, I start getting answers, guys. Come on. This is what is going to build your strategy. Come on. Okay. The most interesting thing is it is good to see so many answers and different ones, because I see that there are a lot of different perceptions, and I'll explain both of these things. Okay, so the popular answer which is coming in right now is you would buy Nasdaq and short sell South Africa. Some of you have said I would buy South Africa and sell Nasdaq. So see, if your individual view right now on tech industry is not very good, then you can sell Nasdaq. But when we are talking about a strategy, I am not talking about an individual strategy. I'm talking about years and years of history. And historically, if you see, so you cannot deny the fact when you see the numbers that Nasdaq has outperformed South Africa more times than South Africa outperformed Nasdaq. Because even in the event of loss, when South Africa went down by 11%, right? Nasdaq went down by just 1.6%. So had you short sell South Africa, you would make 11%. If you had bought Nasdaq, you will lose minus 1.6%. So you would still make net how much? 9%. Similarly, if you bought Nasdaq in 2020, you make 48%. If you short sell South Africa, you lose 7%. You make still net 41%. So this is where your strategy is. So why we do Nasdaq and South Africa? Because we saw their individual returns, right? We saw their individual returns and we said, okay, Nasdaq has gone down by 2 times. South Africa has gone down 4 times. But collectively, when you buy Nasdaq and short sell South Africa and then compare the returns, you will see that even when their individual returns were lower, buying Nasdaq and short selling South Africa outperforms both the benchmarks. This is minus 16%, this is minus 26 and minus 42. So if you had bought Nasdaq and short sell South Africa, you would have lost the least money as compared to both individual indices, right? Now somebody asked me about how about the holding cost? Will we receive holding cost by short selling South Africa? That is another advantage which I'm coming on to, why they call it interest earning ideas. So when you short sell something, you borrow that thing from the broker and you sell it in the market, right? Which means your money is out there in the market earning interest. And South Africa interest rates are much higher than US. So back in 2008, had you see the net holding cost return or interest return you will get on buying Nasdaq and short selling South Africa, that would be 8.9%, which will further reduce your loss to 7.2%, right? And then over a period of time, you will see the returns gaining due to the addition of the holding cost. That's why we call it interest earning ideas. So when you buy Nasdaq and you short sell South Africa, first of all, you short sell South Africa because Nasdaq is a tech sector and South Africa, it is a commodity based economy, guys. Okay. And there's a lot of political issues going on South Africa. So even fundamentally, it makes sense to short sell South Africa. And Nasdaq is a tech index. You're talking about Zoom, Amazon, Tesla, Netflix. So no wonder that year on year, Nasdaq has continued to outperform South Africa. So you buy Nasdaq, you short sell South Africa. And because South Africa has a higher rate of interest, so when you short sell, you receive it. And when you buy Nasdaq, you pay a holding cost. But because South Africa's interest rate is higher, net you receive. So that also adds to your profitability. Okay. Can we buy? Now there's a question. Can we buy and sell both the products in the same platform? Now that you can. Now let me show you how do you do it. Turn whiteboard off. Go to the screen. Trade room. Okay. Now I'm going to take the same example. What I'm going to do, I'm USNDQ, which is NASDAQ. You can add it in your watch list if you want to. And then South Africa, all you have to do is just search on your window, South Africa 40, right? This is NASDAQ, this is South Africa. I open South Africa window, order ticket, to the chart, and then this is NASDAQ order ticket, chart. Look at this. Now what I'm talking about, short sell South Africa, buy NASDAQ. South Africa is in South African ZAR. Currency is different. NASDAQ is in dollars, US. Okay. So there is a difference. 1 unit of South Africa is how much? $3,971. If you convert it in dollars, 1 unit of NASDAQ is $14,000. Obviously, it's not equal. So what you do, if you have to short sell South Africa, let's say worth $100,000, I write $100,000 here in South Africa. I write $100,000 here in NASDAQ. 6 units of NASDAQ, 25 point some units of South Africa. Sell equal value like we did in Pepsi and Coke. So you short sell one, you buy another. And now all we do is just have to hope that by the end of the year, if NASDAQ outperforms, then your buying position will be in profit as compared to the short selling position in Africa, right? Now let's see it subjectively. Okay, if by the end of the period, by the end of the year, if NASDAQ goes up by 30% and South Africa goes up by 25%, you made profit in NASDAQ because you're on the buying position, 30%. But you lost money on South Africa because you were short selling, right? And prices went up. So you're losing money, which means you lost 25% in South Africa, which means you still made net 5% profit on your return. Now look at this, guys, what you're looking right now. We are facing this right now. Look at this. The big difference which started, look, South Africa and NASDAQ both, how they are leveling up with each other right now. It started with a big difference of $40 and now it is barely $10. Now see, NASDAQ is outperforming here. Look at this. Now your pair trade is in slight profit. You see what is happening here? Keep looking. What would be the holding time to see the difference, 0 or negative? So guys, it depends on the drawdown. It really depends on the drawdown. Now, if I am seeing at the flyer right now, what has been the lowest, if the worst return which I have seen in last 10 years, if my loss exceeds that return, then I would want to close my positions, right? Right now, if you see, you're making position in South Africa, you're making profit in South Africa. Why? Because South Africa is going down. You're making NASDAQ profit. Why? Because NASDAQ is going up. So right now, pair trade is going fine. But the idea is to go one of them outperforms another by the end of the year and when the profits are much higher. So this is exactly when we are looking at. Now, let's understand the gestation period. A lot of clients, they do these trades. Sometimes by the end of the week, we get our results, profit or loss. It is up to your risk appetite, how long you want to hold it. A consultant will always give you an opinion, what is his or her opinion, and how long you should buy or hold on to it. But then at the end of the day, guys, it's your own risk appetite, how long you want to do it. You have seen, if you have done this trade right now, let me bring you back the strategy. You have seen that if you hold it for years, returns can be how much? Returns can be this. Look at this. If you hold it for 1 year with the holding cost and everything, in the past we have seen these are the returns right here. Look at this. 2008. So if I see positive returns, 30, 7, 6, 16, 17, 17, 15, 12, 33, 42. What has been the most negative? 7.4, 7.2, 3.8, right? This is 2 times leveraged. With, again, holding cost. If you see holding cost, receive the total return. All I'm trying to tell you is, if I see that my maximum loss in last 10 years in this strategy has been 7%, which means if my loss goes above 7%, I have to book my loss because I don't know what's coming next. Is it the new low, right? So this is how you basically calculate your drawdown. Plus, there are consultants who will tell you when to enter. So guys, again, what I am showing you right now, that if NASDAQ was going up and South Africa was down, then you what you do right here, sorry, if I'm expecting Nasdaq to go up and South Africa to go down, so I buy Nasdaq, I short sell South Africa. But again, guys, these are trades, these are interest earning ideas. So talk to your consultants first, and only then you get into it, because they have a certain rationale which goes behind, right? How did it come to 7.2% for the 2008? Uh, okay, let me tell you. So if you bought Nasdaq in 2008, you lost 42%. But if you short sell South Africa, you gained 26%, right? So your net loss was 16%. Now, in that net loss of 16%, you received interest because you were short selling South Africa, and you paid interest because you were buying Nasdaq. So your net interest earned was 8.9%. Because you had a loss of 16%, you recovered 8.9% because you received interest. So the remaining loss which you had was 7.2%. Right? So now you know how 7.2% comes. So that's the beauty of this strategy, guys. Not only it's a market neutral strategy, it is focused on, first of all, it is focused on minimizing your loss. Let me be very clear with this. I told you one thing again and again, that if you focus on minimizing your loss, you might end up making a return. And that's what market neutral strategies do. They minimize your loss. Okay, there's a question. Please let us know more such hedging pairs. Okay, that's great. So now you've understood this. Okay. And again, these strategies are available. You can talk to your RMs and they will send it to you either way. Okay, now let me show you more of these strategies. So one such strategy is oil. Now, in the very beginning, if you remember, I made you add crude oil futures into your contract, right? Crude oil futures. Tell me how many kinds of oils are there. And I'll give you a hint. Name two kinds of oil. Use your chat option. Which are the two kinds of oil which are available for trading? I told you in the very first day. What are the two kinds of oil, guys? Take a guess. Somebody said Dubai oil. I appreciate. But that's not what is available for trading. Try again. Try again, guys. Try again. That there is actually no right and wrong answer, but I want you to try your best. Okay, I got one answer. Remember, if you have your platforms on, you can just see it. Okay, somebody checked from the platform. Somebody said heating oil. So heating oil is available as a product, but two kinds of major benchmark oil which are traded is Brent oil, crude oil Brent, and crude oil West Texas, right? What is Brent? Brent is the European oil or the UK oil. So Saudi, Russia, Europe, UK is concerned with Brent oil. It's the benchmark. West Texas oil is the oil which is dug in US, okay, which is explored in US. So we are looking at two kinds of oil right now. Now, I told you pair trading or market neutral strategies, how these work is we do not care about what happens to oil prices. Okay. If I tell you that, sir, buy oil, then it means that I am expecting oil prices to go up. But if oil prices go down, then you lose. That's speculation, right? You have some dedicated money kept separately for speculation because that's how online trading platforms work. But I'm giving you something different. If you open crude oil Brent, so I will take you to a far off future contract here. Okay, I will search crude oil, and this strategy is done with a far off future contract. Okay, so I'm taking the last one in crude oil Brent, which is December, on opening it 65.31, and then I am opening the last one in crude oil West Texas also, the farthest, which is December 62. Okay, look at the price. Now, what I want you to do, I want you to calculate the difference between both the prices and tell me how much is the difference between both the prices. Oh, 1 second. Let me switch my screen. Oh, sorry. Screen share. Yes. Sorry. I switched to my screen now. You can see my screen. Okay. See, I have searched crude oil Brent December, which is a far off contract, crude oil West Texas, which is another far off contract, both December contracts. I want you to calculate the difference between their prices and tell me how much is the difference. Tell me, guys, how much is the difference? Use your calculators, of course. Use your calculators. Tell me the exact difference you see between Brent and West Texas prices. One is 62.45, another 65.3. How much is the difference which you see? I want you to calculate exact price. I know it's easy to see right now, 65.2, 62.3, but tell me the exact. It's not 4.5. Look at Brent December and look at crude oil West Texas December. See, there is a reason why I want you to calculate exact. I know it's pain, but just calculate it and I tell you why. So popular answer which I'm getting around right now with the fluctuating prices, 2.86, right? Okay. Now, let me show you how it works. Window, this one here. Now 2.86 you said, everybody said 2.86. Now let me tell you here. Can anybody tell me on the basis of the discussion what we are having, what does this chart represents? I'll give you a hint. It does not represent oil prices. What does it represent then? The kind of discussion we are having. How to calculate, when I said calculate the difference, you calculate the buying price of Brent subtracted with Brent price of WTI. So you will get the difference of 2.85. Now tell me, when I said 2.85 and I show you this chart, what do you think this chart represents? You know, I can easily tell you, but I want you to answer this. Okay, I got one answer right. Others, please go for it. All 63 people right now. Go for it. Go for it. Even if I get 50% answers, I'll be happy. I know everybody is struggling with the time constraint, but today is the last day, so let's embrace the delay here. Okay. Perfect. Okay. So everybody is on board with what does this chart represents, right? This chart does not represent the oil prices. What does it represent? It represents the difference between the two oil prices. So if WTI is $65, sorry, if Brent is 65 and WTI is 62, so whatever is the difference, that difference is plotted in this particular chart. And this is not just 2021. So it shows you the difference between from 2016 and till date 2021. So this difference, what you see here, this is the price difference, right? So if you see the lowest, the price difference between WTI and Brent has been minus 0.16, which means at one point of time it was more expensive than Brent. Right now, Brent is more expensive or WTI? Brent is more expensive. But at one point of time, this difference between the Brent and WTI was minus 0.16, which means WTI was more expensive than Brent. But apart from that, what we have seen is, look at these green dots. And then somewhat here. What does it represent? It represents that every time the price difference which came between oil prices around 2.4 or $2.5, whenever this price difference came here, it bounced back to either 4 or 6, or sometimes it has been hovering around $10 also. This gap between 2018 and 19, which was $10, is now $2.4, which means expectation to go higher because it has done this before. It has done this before. It has done this before. Look at this, right? Now, what you do in this case, you buy WTI and you short sell Brent. No, sorry, opposite. You short sell WTI because you're expecting it to go down, and you buy Brent because you're expecting it to go up, expecting this price difference between both to be higher. Okay, so when this price difference will go higher, either the expensive one will become more expensive or the cheaper one will become more cheaper. Only then the price will go higher, right? The difference will go higher. So that's why you short sell WTI and you buy Brent and see the difference. To replicate the same thing in the platform, how would you do it? Look at this. So now over here, because the pricing is almost same, over here, it's a spread trade, it's a ratio trade. So what you do is, now here, you will not do equal value, you will do equal quantity, which means you are expecting price difference to grow, right? Which means you want Brent to go higher or WTI to go down. So you short sell WTI 1,000 barrels equal to $62,000. You buy Brent 1,000 barrels, buy here, short sell here, and you just took another pair trade, right? Now, what is your profit and loss? How will you calculate profit and loss? If you have entered when the price difference is 2.8, and if that price difference goes, say, to 3, 20 cents up, 20 cents up, which means you are making $200 profit, right? I hope you're able to understand the profit and loss scenario in this. If you have bought 1,000 barrels Brent and short sell 1,000 barrels, and if the price difference grows up by 20 cents also, you make $200. If you had done this with 100 barrels and it goes up by 20 cents, then you will make $20. If you had done 10,000 barrels and it goes up by 20 cents, you make $2,000 profit. Downside also. Okay, so we are doing these pair trades to make you understand this. Guys, again, as I said, you will be getting, you will be getting a lot of consultants from your consultants, the people who are assigned to you. So we will discuss these strategies, and only then you can take these trades with understanding the risk appetite. This is me just telling you what are the other ways to invest into this business. So if you don't understand any of this, you can always go back to your old school investing where you buy some stocks and hold on to it. I have portfolios for that. So the whole point is, this is for whatever you feel comfortable with. Look at this. So I have a large cap portfolio, which you can always ask from your consultant and they will show it to you. So these are some large cap companies which we are looking at: Microsoft, Alphabet, PayPal, Apple, Amazon, Tesla, Uber, Lam Research, MasterCard, Airbnb. This is from US side. And then there is something from Europe also: BNP Paribas, Louis Vuitton, ASML Holdings, Porsches, Adyen. And there is a sufficient explanation given that why it's a buy, what is the target, what is the low. So there are a lot of portfolios which are already available, right? There are different strategies. See, there are portfolio mixes also prepared for you. If you are a conservative investor, how your portfolio should be allocated: 10% in shares, 10% in indices, 10% in forex, 20% in commodities, 50% in bonds, because bonds are relatively much more safer as compared to stocks. So you can replicate these portfolios also. So it is available. Again, I'm just opening new windows of your investment into different areas, right? Similarly, now since we have understood pair trades a bit, there is something called okay, we did interest earning ideas, something what we call as seasonality, a different kind of strategy. So I have to make you understand seasonality and price action, and then we'll be done with some few more strategies here. Look at this. How seasonality strategy would work. Now, seasonality strategy talks about, so we took a seasonality of platinum here, but then it was the older one. I will show you few latest seasonality patterns and I'll tell you how this research works. Okay. Now look at this. Screen share and once again, where did it go? Okay, look at this. Seasonality analysis. Okay. Now, how seasonality analysis would work? Very easy, I'm sure, and it is one of the most easiest you can see before we switch on to the price action analysis. How seasonality analysis work? What we do is we pick a commodity or we pick any instrument and we check their percentage returns month on month over a period of years. Let me show you natural gas, for example. Now, what we did with natural gas, we started analyzing natural gas returns. Okay. And what we started doing here, we calculated natural gas returns for last 10 years from 2011 till 2021 as it goes. This is August, right? By looking at this, if I would ask you, what do you think is the most profitable one? Now, there are 2 months over here, okay? But because this is August, so I've highlighted August. But tell me, apart from August, which month do you think is the most profitable month for natural gas? Tell me, guys. I've highlighted August, but August is because of this month. But tell me, apart from that, which month do you think is the most favorite month of natural gas where you can make positive returns? Oh, too small to read. Sorry, 1 second. Let me increase the size of it. I'm so sorry. Okay. I hope that it is easier now. Actually, the data gets hidden. My screen is only this much. Okay, forget about the year. Just focus on the month, right? So I've zoomed in for now. I hope now it should be visible. Actually, if you just see the colors, you will identify it. Red means negative, green means positive. So starting from January from your left, February, March, April, May, June, July, August, September, October, November, December. That's how it is. Okay. Somebody saying October has been the most profitable. See all the months and give me one answer. Again, I know it's self-explanatory, but you'll be surprised. Okay, I got 15 answers right now, and everybody's saying April, April, April. Okay, April. My question was, which is the month which is the most positive for natural gas? Which is the most positive month for natural gas? Which means more number of greens, right? I will explain it to you. I will explain it to you. Okay, so a lot of you have said April. So as we can see this, look at this. If you see the most number of greens, most positive returns, and isn't it amazing? Sometimes it's the investments are just right in front of you, right here. Look at this. Most of the time, April, barring 1 month here, 1 year in 2019, most of the time, natural gas prices they end positive month in April, right? See, August is highlighted. August could be second best, but I think the best one here we can see it is April, right? This is called a seasonality strategy. Why? Because we study seasonal patterns of which is the best month for this commodity and what is the probability of clients making money if they invest into this commodity in April, right? Now, see, there could be a lot of reasons. So, seasonality is directly concerned with a lot of things due to different. So, for example, why we are doing August here? Let me zoom out a bit. Okay. This summer, less natural gas than normal has been injected into storage. season when companies stockpile in preparation for peak winter demand. Sizzling heat is forcing households and businesses to crank up air conditioning, increasing consumption. Meanwhile, exports from LNG terminals dotting US Gulf Coast are high. Now, you understand why in April it is mostly higher, because there is summers around and there is so much of heat. So a lot of air conditioning is used, a lot of consumption is used, and that is why the demand for the fuel goes up. So if you see in April, most of the time you see a positive return on it because the demand for natural gas is surging during this time, right? Additional seasonality favors the price of natural gas. If you see, August has been more positive. Commodities, 7 out of last 10 years, provided an average return of 5.6% in month of August, with maximum return of 46% and maximum loss of 13%. This is the season when companies stock up natural gas in preparation to the peak winter demand, thereby resulting in upward pressure on prices. Again, guys, April or August, there are different reasons for the seasonality. And when you are talking to your consultant, they can bring out these kind of strategies also and explain it to you. So that is called seasonality pattern or seasonality based strategy. So what did we understand? We understood about pair trading, NASA, oil, Brent and WTI, which is spread trade. We talked about stock pairs. We talked about seasonality analysis. We looked at a long-term portfolio as well, right? Now, similarly, one more thing, since we are doing so many strategies, something what I want to bring your attention to is price action analysis. Now, this is specific. This was the flyer prepared yesterday. This is for earnings season. Remember, I talked about earnings season, how important it is for a stock in the earnings season. Now, I am providing you a price action analysis strategy, which you can try during the earnings season. What does it do? It does an analysis of different years. Okay, guys, this is going to be the last strategy or second last strategy, which I'm talking about. So just understand it. I'll take 15 more minutes before you guys leave. So if you can wait for 15 more minutes, I'll be done with my strategies. And if you will have any questions, I'll be able to answer that. Just 15 more minutes I need. Now, if you look at earnings, normally, what did I tell you? How we settle earnings? If I expect that the earning estimate of a company is going to be good, I buy. If I feel that the earning estimate of the company is not going to be good, I short sell, right? Both ways, there is a idea that I'm speculating it. By doing a price action analysis, what I do, I strategize this. Let's see NVIDIA first. Okay. Now, NVIDIA is declaring its earning 19th August. Okay. Now, if you enter, so what we did, this is Q2. This is the second quarter earnings for NVIDIA. Okay. Now, what we did, we started doing an analysis and said, okay, if we compare, sorry, this is what? Okay, 2021 Q2. Okay, this is Q3 then. Yeah, sorry. If it started with December, Q2 average. Okay. Oh, when it started. Okay, perfect. Yeah, Q2. So what we did, we started doing a research of the previous years of the same quarter. Had you entered a day before earning, when I say enter, which means if you had bought NVIDIA stock one day before earning and exit after 1 week, and if you had done the same thing in last 8-9 years or 10 years, how the stock or how your portfolio would have reacted to it. Once again, guys, hear me out. Very layman, very easy to understand. If you had bought NVIDIA stock in last 10 years, every time for the second quarter, if you had bought NVIDIA stock a day before its earnings and exited a week after the earnings have come, what your returns would have looked like. So in 2012, if you had done the same thing, you would have made negative 11%. In 2018, your returns would have been negative 2%. But overall, on an average, if you do that, your return would be 4.1%. And the probability of gain in price will be 80%, is if we compare the 10 years performance. Maximum gain you can make is 15%. maximum drop in price could be 11%. So that's your risk and reward. But look at this. If you had entered a day before earnings, okay, and instead of exiting on a week, you exit roughly after 1 month, then the probability of positive return becomes 90%, highest return 23, and the lowest or the loss which you could make is 6%. What does it mean? It means today when you are talking to me that Yogesh, what should I do with Nvidia? If I'm a common analyst, I'll tell you, sir, Nvidia has shown normal results and I think the results could be positive. You know what? Let's buy the stock. That's one scenario. But what if I tell you, sir, in the past 10 years for the same quarter, we have done a lot of research. If you enter in Nvidia stock a day before the earnings, and if you exit after a month, had you done this in last 10 years, the probability of price going positive and you earning money is 90%. Highest return you can make is 23%. Your risk is around 6%, which is the highest loss which we have seen, right? This is called price action analysis. This is the strategy which you can use, right? Better than speculation, right? Better than thinking whether the price will go up or down. You are looking at historic prices and trying to make an assumption out of it. Can it go wrong? It can. But that's why we compute probabilities. This is the game of probabilities here when we look at last 10 years, right? Makes sense? I hope everybody is understanding what I'm saying here. If you have any questions, please feel free to talk about it. But see, this is again a strategy which is talked about a lot of times. Look here, once again. Synopsis. It's a company, earning date 19th. Now, in this case, if you had entered 2 days before and exited after 2 days or exited on the day of earnings, right? You enter 2 days before and you exit on the day of earning after the earnings come, the probability of gain in price is 70%, maximum gain 7.5, maximum drop 6.5. But had you entered 2 days before the earnings comes out and hold on to for the next 20 days, you will see the gain probability of gain in price is 80%. Highest return you can make is 14 and loss which you can make is 10%. That's your window. That is the window. If your loss exceeds more than 10%, please close. Because in last 10 years, you have not seen an average loss of more than 10%. Right? Makes sense, guys? So when I used to tell you that there is a strategy for everything. So go back to each and every person who tells you, I have lost all my money in financial markets. You cannot lose all your money in financial markets. I mean, structurally you can. But I'm saying that if you over leverage, if you don't put a stop loss, if you do not diversify, if you don't strategize, yes, I mean, if you are doing all of that, you will lose all your money. But if you don't take an over leverage, if you put a stop loss, if you diversify enough, if you strategize, you use strategies to do it, then there is a way that you can minimize your loss. My entire focus in these sessions has been to make you aware and spread awareness about how you can do a lot of things strategically. You do pair trades, you can do seasonality trades, you can do price action analysis whenever the earnings comes out, right? You can diversify, you can invest into ETFs, you can do long-term portfolios. Let me show you one last thing which is there. Something called, so this is also we made day before yesterday. Will gold price repeat history and rally after flash crash? I don't know how many of you know, but gold prices crashed in last 2 weeks. And we have seen this has happened 10 times before since 2019 when gold has lost around 2% in a day, 4.5%, 5%, 2.3%, more than 2% whenever gold has lost in one day. After 1 week, if you enter, so let's say whenever gold crashed more than 2%, and after 1 week after crash, if 1 week after the crash you entered and then you exited post after 1 week, average return you could have made is 2.4% with probability of gain in price 80, maximum return 8.6, maximum loss minus 0.2. Similarly, if you enter 1 week after the gold crash and exit 2 weeks post entry, the probability is still 80%, but the average return increases. Maximum return is, however, less. Again, guys, a price action analysis. So when gold crashed last week, we started finding out that has this happened before, that gold has lost more than 2% in one day. And we saw in last 2 years it has happened 10 times. Okay, if it has happened 10 times, what has happened after that? So if you enter into a trade 1 week after it and hold on your trades in gold for 1 week, this is the anticipated probability of gain in price, 80%, right? So I'm talking all the numbers which are probable numbers. So please understand this. I'm talking about the game of probabilities. You still can go wrong. So that's why you put a stop loss. There is a question, what way gold crash affects fall in silver? So it's a very popular question asked, that how gold and silver are related. See, both are precious metal. In the history, we have seen historically that when gold goes up, silver prices go up also. But gold is a metal which is surrounded by news of everything. So gold prices fluctuate on uncertainties, interest rates, everything. However, silver prices get affected when there is an industrial issue, because silver is more of an industrial metal. It does not get affected by what happens around the world like gold. But silver effect is affected by the manufacturing fall. So if there is a delta variant possibility of a lockdown or a shutdown, if manufacturing is slowing down, then silver prices will drop. And at the same time, gold prices will go higher. Something what we call as a gold silver pair trade, right? Which happened in the past when we expected gold prices outperformed silver a lot of times, and we expected that gold will come down and silver will go higher. So that was the time when silver went up from $18 to 30, while gold stayed at the same time. So a lot of people made money in gold silver ratio. So that is also something, a strategy which you can do. But gold crash does not affect directly silver, because in the past we have seen that gold and silver has been proportionally related, but now gold is reacting to interest rates, it's reacting to uncertainties, it's reacting to a lot of things, while silver is mostly reacting to the industrial demand. So that would be a better way to look at this. For those investors, somebody asked me right now, do you have something for a conservative or a less adventurous investor? Look at this. I opened this tab here. Something called a low beta dividend portfolio, which means low beta means the stocks which are less volatile and give you a fixed income. They give you a dividend. Okay. This was a portfolio which was made, and all these companies, if you see right here, and you can talk to your RMs, they will send you these portfolios also. These are property, real estate based companies, tobacco based companies, telecom based companies, and they have good dividend yields. Look at the dividend yield: 8% dividend yield, 8.3% dividend yield, 6.5% dividend yield. So they give you a fixed dividend also, and these are very less volatile. So the beta is considerably low as compared. When I say the low beta, that means that when market will fall, if these stocks have a low beta, as compared to the markets, these stocks will fall less, and they are less volatile to the market movement. So this is something which you can also look and invest into. So what we are talking about right now, we are talking about a portfolio, okay, out of which a portion you dedicate to your day trading, which we talked about, commodities, crypto, short selling, you do everything. And a portion of your portfolio goes to your long-term stocks. Now in long term, you invest into large cap likes of the Apples and Amazons, and then you invest into some futuristic companies, right, which are growing right now, small market values. And then a portion of that stocks also you invest into those companies which are giving you good dividend and are less volatile. And then this is your long term, this is your day trades, come between your strategies where you can do your pair trades, your oil strategies, and a lot of other strategies which are something which you can do. Now look at this right now while we are talking. What happened to our NASA strategy while we are discussing here? Look, Nasdaq profit is 167 here, okay, and South Africa loss is $66, which means I'm looking at a net profit. Obviously, you are not trading for this smaller amount. So that's why you hold on to this trade for 7 to 10 days till you see a considerable amount of profit, and you can talk to your consultant about this, that what is the expectation, right? So this is something which is there. A lot of such pair trades can also happen. If you want to do more of these pair trades, this can work out with a lot of other issues. Look at raw sugar and Brent oil. This is also a ratio trade. Sugar prices, ethanol demand is very high, so it is expected that sugar prices might go up while oil supply is higher, so oil is expected to come down. So you buy raw sugar and short sell oil. Their spreads are also at historic low. Okay, so spreads are also expected to go higher. So this is another pair trade which you can look into. So there are a lot of such pair trades which we are still looking at, and every day the researchers over here, they are working to create something different. So this is corn and Invesco DB Agriculture Fund. Okay, corn and Invesco fund, they are correlated with around. So if you see this agriculture fund and corn as a commodity, the correlation is around 68%. Last 5 years, the corn and this fund, the correlation has been more than 65%, right? The current ratio is around 28. Highest in the last 1 year has been 37. The ratio means the price of corn divided by the price of the fund, whatever is the remaining is the ratio. And this is the chart of that ratio, that what is the highest and what is the lowest. So on the basis of ratio, if you're expecting ratio to come down, you buy one, you short sell another, you talk to your consultant, and they guide you towards how to do it. And we can send you all these strategies, and we can sit with you and explain it to you how these strategies work, right? So most of my presentation revolves around these kind of strategies which I have already spoken about: interest earning ideas, seasonality patterns, again bond yield spread strategies, sub trading, multi-class trading, the same thing what we talked about. So again, guys, the entire agenda of this session was to spread more and more awareness. I hope I have tried my best to give you as much knowledge as we can, but it doesn't end here, and it doesn't have to end here. A lot of you will ask that why do I have to sit and listen to you for this, and why do we have to get involved into it? Off lately, I've been hearing this line a lot. Every person has two lives, and the second life starts when you realize that you have only one life. So all I am trying to do is trying to make you independent when it comes to making your financial decisions, but you're not alone. You have our consultants, you have these training sessions, you have webinars, you sit and talk to us, and we'll give you all these strategies and will train you harder. And we are still doing this free of cost. This is bond yield. Somebody asked about bond yield strategy. Let me show you the bond yield strategy here. I have opened it. It's here. Look at this. So this was something which we created in the beginning of the year. Okay. This was between the European and the Italian and the German bonds. The yield difference, the yield spread, the bond yield spread between. So this was the Italian. That time, the Prime Minister Giuseppe Conte was on the verge of collapse after the coalition, and this resulted in investor confidence diminishing in the Italian government. Moreover, investors are increasingly concerned that breakdown might hamper Italy's COVID-19 virus response and cause a delay, right? So the BTP bond, BTP is the Italian bond is the German. So the 10-year spread, the difference between the prices of the yield prices of the German and the Italian bond went down to 5-year lows to here, 119, right? So all we talked about was market seemed very optimistic. Blow up in political tension could result in a widening of yield spreads. There is a probability of Eurosceptic parties gaining on others' expense. Nevertheless, Italian bonds seem richly valued relative to its German counterparts. So you buy one and you short sell another, and that's where the bond yield and spread. So you went short on Italian bonds, you went long on German bonds. So the BTP is Italian, the bond is German. Because of the political conundrum in Italy, we thought that Italian short position is better and German bond position go for a buy, and you capitalize on the bond yield spread, right? So this is something, again, whenever this strategy comes in, we'll prepare it and we'll send it to you, and something which you can always look into. Now, so as I said, guys, There can be a lot of strategies related to price action analysis, related to bond yield spreads, pair trades, and we are there to help you out. Uh, I have explained you how the platform works. I'm still available for a one-on-one session whenever you want, right? So do not worry about it. Uh, as I said, is there any risk? Yes, there's a big risk. If the pair doesn't go your way, then you can lose money. But that's where I'm coming in, where I'm telling you that how much you can invest and what is your risk, what is the maximum drawdown, what you should have to be ready for, right? So, guys, it was a pleasure, and I'm available for one-on-one sessions. Please, if you liked these sessions, you want me to continue doing this in the future. If you have not reviewed us on Google yet, I would humbly request you to give your feedback. And I'm more than grateful, all of you, 40, 50, 60 people, so many people, they have come on the first day, they have stuck by with me on second day. Those who came on second day are stuck by till the fifth day. And this is not something which I see always, but this is really amazing. Once again, thank you so much. It's been a pleasure. You can always reach me out for a one-on-one session. I'll be able to help you on this. Talk to your relationship managers. For the last time, a big word of thanks on behalf of my family, my team, to those warriors who belong to the healthcare industry and related industries. If you are one of them, if you are doctors, nurses, midwives, fast responders, everyone who have risked their lives for us in the COVID pandemic, I wish you a great health and a big word of thanks. I would be available with all these strategies, and we will continue to do these kind of sessions. Next year, we'll continue with different webinars on different kind of thematic investing and strategies and a lot of it. I'm available for one-on-one sessions once again. So please continue to look at the watch list. Please do not stop watching the watch list. Continue to use the watch list. Reach me out. My email is yogesh@sensu.ae. If you need my contact number, you want to add me on WhatsApp, you can add me on WhatsApp as well. Just send an email and I'll send you my contact details. Normally, I do a lot of talk shows on 100.3, and whenever I'm going next on talking about different topics, definitely we can, you can catch me there. Is your one-on-one session free? Absolutely free. Absolutely free. There is no charge to knowledge. Don't worry about it.